The Bank of England today has delivered on monetary easing. We've got a rate cut from 0.5% in the base rate down to 0.25%. We've also got an increase in quantitative easing. The Bank of England will now buy 60 billion of gilts, government bonds, over the next 6 months, and also look to buy up to 10 billion of corporate debt. These are measures designed to stimulate the economy by lowering interest rates and encouraging investors to essentially come out and buy risky assets. And in particular, if we look at the market reaction, the Bank of England should be happy here. You've got a weaker currency, but you've got higher stock prices and higher bond prices as investors react to this monetary easing. If we look at the FTSE 100, it's up 1.4% as we speak, and more importantly, banks are in positive territory. One of the dangers of cutting interest rates so close to zero is the fact, as we've seen in Japan and in Europe this year, banks don't like this. Shareholders have been selling out of the banks as a sector in general because low rates, and in particular negative rates, hurt the net interest margin for banks. Now, Bank of England has signalled that it's cut down to just 0.25 point, but expectations are that it should probably stay here, let QE do a lot more of the heavy lifting, and of course we're going to be looking forward to what the Chancellor says in his autumn statement. Expectation here is that now that the Bank of England has moved, we're going to see some kind of fiscal response from the UK government. So if we look at interest rates here across the markets, we're seeing a nice rally in gilt prices. We've seen gilt yields drop more than 10 basis points in the 10-year sector. We're at a new record all-time low for the 10-year gilt, around 0.66%. We've also got the 2-year gilt yield back below 10 basis points and heading towards zero. The question that some investors will probably be asking as QE gets going in the coming weeks is whether or not we're going to actually see some negative yielding gilt securities, particularly in the short end. In terms of the currency, well, that's the big mover. Pound has taken another drop down today. It's down more than 1% against the dollar. It's nearly down 1% against the euro. And this really is the safety valve for the UK economy. And this is really what the Bank of England, I think, wants to see. It does want to see a disorderly decline in the pound, but it does want to see downward pressure that helps alleviate some of the post-Brexit vote slowdown that we are expecting for the economy.